Hello, I'm Marianne Devaney. Business owners have a lot to think about, let alone worry about how to manage currency risk. But with the Canadian dollar falling nearly 6% since the end of June, the risks are definitely real. So today we're looking at where the currency is going and what you can do about it. I'm joined by Shaun Osborne, who's Chief FX Strategist, and Nancy Pack, a Vice President Business Development, both from TD Securities. So let's start with you, Shaun. We know that with the Loonie, oil has had a lot to do with what's going on. What's been happening?
Well, I think a number of things have conspired to drive the Canadian dollar down. Weaker growth in Canada, some disappointing numbers. Certainly the Canadian economy seems to be lagging behind the recovery in the US, and more recently we've had quite a bit of pressure on commodities generally, but oil prices more specifically over the past few weeks have really captured the attention, I think, of investors, with oil prices getting close to $80 a barrel. It's getting very close to that very sensitive break-even point for oil producers in Canada, in the oil patch, so that suggests that growth and investment in that part of the economy may slow further, which has been a key driver. Big concern. But because that area of the economy has been such an important driver of growth and employment growth in Canada over the last few years. So all these things are conspiring to keep the Canadian dollar quite depressed. It's about where we thought we'd be at this stage of the year. We've been looking for the Canadian dollar to weaken. We think there's probably a little bit more weakness to come.
Where do you see it going from here?
Well, I think we're certainly looking for dollar Canada to rally towards the 115 level in the early part of 2015. I think there is a risk, though, that looking at those kind of levels and the degree of movement that we've seen recently, that we get to that point maybe a little bit earlier, and we may even see something of an overshoot in 2015 beyond that.
Okay, so we could see a half-decent movement. What about when the Bank of Canada came out this week, dropped that forward guidance, removed that word neutral? That seemed to be a bigger deal than you would expect. Yeah,
I think there was, I call it an overreaction in the markets, at least initially. Obviously, there was a lot of other things going on, unfortunately, that day, so the market did become a little bit distracted from the bank's decision. But essentially, I think what the bank did there was try and give themselves more flexibility with their language and not be pinned back by this notion of being neutral at a very low level. The bank is basically saying that right now that the policy outlook is balanced, which is more or less the same thing. So I don't think in essence anything, I'm certain that nothing really has changed in their view. They're no nearer raising interest rates now than they were Tuesday evening. But I think it was a language change, a change in communication strategy that is trying to give Governor Pollers, I think, a bit more flexibility in how he addresses some of the issues that we're going to be facing going forward in Canada over the next few years. Because, next year specifically, I think if you look at the revised growth and inflation outlooks that we had from the bank, they've certainly given the inflation outlook a bit of a nudge lower into 2015, which suggests that there's probably going to be no move at all in interest rates, certainly for quite a period of time.
So if we're expecting US dollar to go higher, how long do you think is that going to be a number of years it keeps going that direction?
I think it's quite possibly a multi-year movement. We are, I think when you look at the history of the US dollar, it tends to move in these very long secular trends. That's why people like foreign exchange and like to trade foreign exchange, because it does trend directionally very well. And I think when we look at the history of the US dollar since the 1970s, it's moved in these alternating waves of strength and weakness that tend to last about 8 years. It's a very regular pattern of strength and weakness. And we're assuming that the last base point for the US dollar was sometime between 2009 2010. And if we're seeing something similar to what we've seen over the last 30 or 40 years, that we're about midway through what may be a multi-year move in the US dollar. It's difficult to put a specific endpoint on that, but in terms of the time duration, there's probably another couple of years at least to come in this.
All right. Nancy, so let's talk about what we can do about it. If I'm a business owner and I'm, say manufacturing, just as an example, we'll take an example, and I need to make those regular purchases of equipment, materials, whatever I need. Say I got to buy it from the U.S. What can I do? I'm in Canadian dollars. How can I mitigate that risk?
Yeah, absolutely. And it's certainly businesses that are U.S. dollar buyers at this moment aren't liking it. And, moreover, it's the speed at which it's happened, in particular the last 3 months. So looking at businesses that do have goods or equipment purchases in the U.S., they want to know what those are, know what their forecast is, understand what their budget is, and be able to overlay the market forecast, build their own view on it, of course, but look at hedging strategies. So the ability to book forward contracts, for example. A business could look at 1, 2, 3, 6 months out if they've got those cash flow projections and be able to book forward contracts and lock in a certain amount of US dollar purchase at today's rate for a certain period of time and be able to smooth out and frankly match up the cash flows that they have coming up in the foreseeable future and be able to know what their costs are going to be irregardless of what's going to happen with the currency in the interim.
Mm-hmm. So it's not so much that I'm trying to speculate on will the dollar go up, will the dollar go down. It's just that I'm actually removing that risk because I know today how much I'm going to pay, say, in 6 months for that piece of equipment.
Yeah, exactly. I mean, you want to smooth out the cash flows. A business wants to have the ability to plan.
Unexpected costs coming up.
Exactly, and to be able to sleep at night.
Exactly. And thank you very much to you both. I've been joined by Shaun Osborne, Chief FX Strategist, and Nancy Pack, VP of Business Development, both from TD Securities. Thanks for watching.